Let's also listen in from a view coming in from Girish Pai of Nirmal Bang. We spoke to him earlier in the day about his two top picks. Let's listen in.
We've had a recent initiations on certain stocks. One is in the consumer electrical space. So that is a consumer discretionary consumer electricals, certain select NBFCs, certain select autos. Those are the kind of areas within the market which have kind of attracted us. So within that, we kind of initiated coverage on a couple of stocks recently. One is Gabriel India, which is an auto ancillary play. The other is Whirlpool. Yeah. So Gabriel is a company which manufactures shock absorbers and it manufactures for two-wheelers, passenger vehicles, as well as CVs. We think that the two-wheeler growth, which has been in low single-digit territory in the last couple of years, that's going to pick up into high single-digit to maybe even low-teen kind of a number into FY18 and 19. So there is that growth pickup which is going to deliver numbers for volume growth pickup for Gabriel. On the passenger vehicle side, we think that the growth is going to be fairly steady, high single-digit to low-teen kind of number continuing for passenger vehicle side. And CV side, we are expecting only a mild pickup in growth. So Gabriel has been a player which has kind of been, selling shock absorbers to some of the players which have been growing faster than the industry. So TVS Motors, HMSI, especially on the scooter side, not so much on the motorcycle side. Those have been key players in the two-wheeler front. It's not been addressing a very large part of the two-wheeler market, which is the Hero MotoCorp's motorcycle segment, two-wheeler segment entirely, Hero MotoCorp as a company. And within the HMSI, it's not been addressing the motorcycle part. So somewhere down the road, we think that it will probably make entry into these two companies, especially in HMSI and the motorcycle part of, motorcycle part of HMSI and Hero MotoCorp's entire product portfolio, which should drive growth for it going into FY18, 19 and beyond. We think that, we should see something like low-teen kind of revenue growth come through for this company and with some amount of revenue mix change. So we think that right now we have a situation where about 82%, 83% of sales is to the OEMs. About 10, 12, 13% is coming from aftermarket and the rest is coming from exports, which is the latter two are slightly better margin businesses. So once we see a revenue mix change, we think that margins will improve from here. So we think that about 100 odd bips of margin expansion could potentially drive EBITDA growth. So we think that on a 12-14% kind of revenue number, we could potentially see a 20% plus kind of earnings growth come through, and the stock is currently trading at something like 14-15 times FY19. We think that the stock can potentially go up to as high as 18 times, considering the fact that return ratios have been fairly good. ROCs have been on the last 2-3 years have been about 25%, and we think that will continue going into the near term, especially in the next 2 to 3 years. So that is a area to watch out for. The other stock we like is Whirlpool. Ever since we initiated the coverage on stock on the coverage on that particular stock, it's kind of run up quite a bit and it's closer to the target price. But we think that the P multiple expansion story could potentially continue for this stock even going forward. We've seen this happen with multiple consumer related plays. So right now we think that the stock is trading at somewhere close to 33-34 times FY19 earnings. But this is a company which we think can deliver fairly strong earnings growth going forward, 20% plus earnings growth. So we've seen this is an MNC stock in the consumer space, which can deliver a revenue growth of about 14-15%, and which will see some margin expansion also coming through. So 20% plus earnings growth. So we do have MNC players with very good return ratios in other areas of the consumer sector, which trade at some crazy PE multiples. This is a company we think can deliver ROIC of upwards of 100%. So, and considering the kind of flows we've seen into the equity markets, especially on the domestic side, and hopefully we will see some reasonable amount of flows even from the FPI side, we think that quality stocks like Whirlpool will continue to attract flows, and will the PE multiples can expand there. So Whirlpool is a play on home appliances industry. So home appliance industry, Whirlpool is focused more on refrigerators and on washing machines. The penetration levels on both are fairly low right now. Washing machines, the penetration rate is something close to 10-11%. If you look at the Indian household sector, refrigerators are probably around 23 to 25%. So we think that one, penetration improvement from here, disposable income growth, affordability. So the prices of these products have not really gone up. The fact that distribution, the expansion of distribution network is going to happen. We think that distribution can potentially move up pretty substantially for Whirlpool, even from where it is right now. And some new product introductions. So we will probably have the company delivering new products like higher end refrigerators in the price category of 50,000 to 100,000. And some front load washing machines is what we think is a new product category that it'll introduce going forward. So if you look at the revenue mix of the company, 60% comes from refrigerators and 20% comes from washing machines, and that is and about 10% comes from AC. So we believe that they're going to introduce a new product on the AC front, which is going to be an inverter AC. So if you look at these product categories, a refrigerator is a fairly technology intensive kind of a product where some 5 players control about 90% of the market, unlike an AC where apparently the market is split across something like 70 players. So it's a fairly concentrated market and a fairly technology intensive market where we think that Whirlpool has got a reasonable market share. And we think that that area can potentially grow 15% plus going forward. And on the washing machine side, we think that introduction of the front load washing machine could potentially be driving growth for this company. So that's the kind of revenue mix picture we have for what's going to drive revenues for Whirlpool. And as I said, it's a company which is delivering you an ROIC of greater than 100%, backed with technology from the parent. And I don't see any reason as to why the multiples, yes, they may look optically very expensive, but we've seen these kind of situations in the past where multiples of MNC companies have traded much higher. So from a 33 P multiple that's currently trading, and it could potentially move up much higher from where it is right now. And considering the fact that it's an MNC which is going to deliver you a 15% compounding and revenue growth and maybe 20% plus in earnings growth, there are very few MNCs which kind of deliver you those kind of revenue and earnings growth numbers with a very high ROIC. So this could be a very attractive company to look at. And we think that PE multiples can expand even from where my analyst thinks it can potentially trade it. So these are two stocks which we had a recent initiation of coverage on.